A major escalation has occurred in the ongoing confrontation between the United States and Canada, fundamentally altering the dynamic of the dispute immediately. Canada has enacted a substantial retaliatory response, moving beyond symbolic gestures or diplomatic complaints to deploy a strategy that observers describe as harder, faster, and more precise than anticipated by the Trump administration. The immediate effects were observable as markets reacted and governments began urgent consultations. This development signals that what began as political theater has transitioned into a strategic collision, carrying real economic consequences and diplomatic fallout. Experts suggest this is not a routine trade dispute, but a test of leverage, credibility, and alliance discipline inside a broader struggle over economic sovereignty and supply chains. The global signal being sent is that United States pressure on a close ally will now be met with a tangible cost. This report will detail the mechanics of Canada's retaliation, why it is viewed as a strategic countermove that targets specific economic and political pressure points, and the emerging reaction from markets and diplomatic allies. The core of the Canadian response lies in a package designed to expose the specific vulnerabilities of the United States' industrial and economic model. Rather than engaging solely on the rhetorical terrain established by the White House, Ottawa has shifted the battlefield to focus on integrated supply chains and regional stability. This retaliatory framework includes targeted economic measures, threats to redirect trade, and the strategic utilization of critical exports. These measures are described as surgical rather than emotional, focusing on industries where the United States maintains a high degree of dependence. Specifically, the response leverages Canada's role as a primary provider of energy, aluminum, timber, uranium, potash, and critical minerals. Because the two nations operate as a shared industrial machine, particularly in auto manufacturing and cross-border logistics, these disruptions are expected to be felt across integrated production lines. Analysts note that the Canadian move is calibrated to create measurable pain in commodity markets, business confidence, and consumer prices, specifically targeting sectors that form the backbone of the Trump administration's economic messaging. Initial reports from within the Trump administration suggest a state of emergency as advisors attempt to contain the fallout. The initial premise of the administration's strategy was based on the assumption that Canada's economic intertwining with the United States would force a quick concession. However, the intensity and coherence of the Canadian counteroffensive have reportedly stunned officials in Washington. Behind the scenes, the level of preparation involved indicates that Canadian officials had wargamed these scenarios, consulted with industry stakeholders, and likely briefed allied capitals well in advance. This activation of a prepared defense has forced a recalculation within the White House. Lobbyists and business leaders are reportedly flooding government offices with warnings regarding sector damage, while diplomatic allies are questioning whether this bilateral fracture will lead to a broader breakdown in Western economic coordination. As media coverage shifts from the original American pressure tactics to the scale of the Canadian retaliation, the administration finds itself in a reactive posture, struggling to maintain its narrative of dominance in the face of a visible and organized resistance. The strategic implications of this confrontation now extend into the long-term stability of the North American alliance. By demonstrating that size does not equate to absolute control in an interconnected system, Canada has challenged the traditional model of American leverage. The domestic political cost in the United States is expected to rise as retaliation impacts production timelines and investor confidence. If the dispute continues to escalate, it risks expanding beyond tariffs into critical areas such as procurement, investment screening, energy coordination, and border operations. Observers are now monitoring three potential outcomes: a rapid de-escalation through quiet negotiations, a period of controlled escalation where both sides continue to exchange sector-specific blows, or a more dangerous spiral that could destabilize broader markets. Other global trading partners are watching closely to determine if structured resistance against the administration's pressure tactics can be successful. The immediate consequence of this shift is that the burden of control has moved. The administration must now weigh the political necessity of maintaining a strong image against the material economic damage caused by a prolonged trade war with its largest partner. This event marks a turning point in the use of pressure politics, as the focus shifts from rhetorical threats to the management of real-world costs and the preservation of essential supply chains. For more updates on this developing situation, please subscribe to our channel.